Okay, so we're working on chapter 5. Notice that we're going to have a little time. That the chapter 5 homework isn't due until November 6th. Let's look at the window. Okay, so you could start it now. And it's not due until November 6th, right? Which isn't this, it's not tomorrow, it's next Friday. Okay. And then chapter 6 is due the following Friday. Now, why do I mention that? Because exam 3 is based on chapters 4, 5, and 6. So if we look at exam 3 due date, November 16th. Okay, so, it seems, like it's pretty far away, but it'll be here before you know it. The good thing, though, is that these chapters really aren't, in my opinion, I don't think they're that tough. Let's take a look at something. So if we just look at the learning objectives, right? We're going to do this first one. Identify costs as variable, fixed, or mixed. We're not going to bother with step. Variable, fixed, or mixed. So another way of looking at cost, right? We've been talking about cost for a few chapters now, and this is another way of looking at cost. We're not going to do number 2. Number 3, use the high-low method to estimate cost behavior. This deals with mixed cost. A mixed cost is one that is part variable and part fixed. Well, how do we determine how much of it's variable and how much is fixed? We use this thing called the high-low method to do that. We skip number 4. Number 5, prepare and interpret a contribution margin income statement. Now, you know what an income statement looks like, right? They call that full absorption income statement. And so the income statement you're used to in this chapter, they're going to refer to it as the full absorption costing income statement. But this contribution margin income statement is going to be called variable costing income statement. So it's just another way of looking at the income statement. Instead of analyzing the income statement in terms of what we know cost to be now, right? What is cost now? If we split it between variable and fixed, how does that change the income statement? Okay, so with that in mind, let's take a look at this video. Low again. Okay, so I want to do another problem with you, right? Because we have some time left. And let's find one. I want to do exercise 4, which is on page 241. Okay, and maybe, try to pull out a piece of paper and pencil and see what you can do with this too. Try to do this in steps. So Morning Dove Company manufactures one model of bird bath, which is very popular. Morning Dove sells all the units it produces each month. The relevant range is 0 to 1,500 units, and monthly production costs for the production of 500 units follow, right? This is how much it costs them to produce 500 units. Morning Dove's utilities and maintenance costs are mixed with the fixed components shown in parentheses, right? So you see all the costs listed here. Identify each cost as variable, fixed, or mixed, and express each cost as a rate per month or per unit. State any assumptions that you make. Determine the total fixed cost per month and the variable cost per unit. Right? Forget number 3. And calculate Morning Dove's expected total cost if production increased to 1,200 units a month. Okay. So let's see how to set that up. I'll use Excel. Right. So this is exercise 5-4, right? And this was on page 241, if you want to go back and look at it yourself. And what I'm going to do here is I'm going to try to make a table where I can answer as many things as I can in one place, right? So here what I want to do is I want to list the costs, production costs, right? Total cost per unit. Right? And whether it's fixed or variable, right? If it's variable, we'll say VC. If it's fixed, we'll say FC, right? How's that? So the first one they list is direct materials, right? And that's $1,500, right? And direct materials is a variable cost, right? Now, on a per unit basis, what would that be? 1,500 divided by 500. Remember, this is based on 500 units being produced. So that's $3 a unit. $3 a unit. And that's variable. Direct labor was 7,500. Now, on a per unit basis, 7,500 divided by 500 is what? $15? Right, $15. And direct labor is, right, another variable cost. Utilities. Now, utilities is an example of a mixed cost. So how much of it is variable and how much of it is fixed? Okay, well, if the total cost was $650 and the fixed portion is 100, right? That means it's $550. The variable cost is $550. Now, maybe this total cost is the wrong name to call this, but I think we can work with this like this. So what's the cost per unit then? My spreadsheet's out of control. $550 divided by 500, I have no idea what this is doing. 550 divided by 500 is what? $1.10. Okay, $1.10 variable cost, right? And fixed cost, let's make another column. Fixed cost is 100. And we don't have to worry about per unit with fixed. They're not asking for that. Okay. What's next? Supervisor salary. Okay. Now, that is, let's say here for this, just not to confuse the issue, right? This was both. This was variable and fixed. Why don't we just say mixed? The supervisor's salary was $3,500. It's fixed. The whole $3,500 is fixed. Maintenance. Right now, the total was $480, but the fixed portion was $280, right? So this is another example of something that's mixed, but the fixed portion was $280, which means the variable portion was how much? 480 minus 280 is 200. And 200 divided by 500 is 40 cents. And last but not least, right, depreciation. Depreciation was 800. And depreciation is almost always fixed. I can't imagine that it wouldn't be. Okay. Right. Now, total. What's the total cost per unit? Variable. $3 plus 15 plus $1.10 plus 40 cents. $19.50 per unit. $19.50 per unit. The total fixed cost is $4,680. So that's your answer to the first part of the question, right? The first part of the question asks you, identify each cost as variable, fixed, or mixed, and express each as a rate per month, right? That's what this column does here, the cost per unit. State any assumptions you make. Well, I don't know, it's pretty evident. All right, so that's the first part of the problem. I'll say totals here. Right, determine the total fixed cost per month and variable cost per unit. Well, we did that too, right? That's here. So if you wanted to say what we did up here was part one, and what we did over here was part two. Then part three, forget, because we didn't do, that linear equation. Calculate Morning Dove's expected total cost if production increased to 1,200 units per month, right? So this is part four. If production increased to 1,200 units per month, okay? What would happen? Well, the variable cost would be 1,200 units times $19.50 a unit. So what does that come out to be? 1,200 times 19.5 is 23,400. And the fixed costs well, here, right? It's 4,680. So what would the total be? $28,080. Right? So a nice little problem. I mean, it's, it's not a very long, but I think it proves a couple of points, right? It helps you to distinguish between variable and fixed. It helps you to calculate total fixed costs. It helps you to come up with per unit amounts for the variable costs, right? Based on the 500 units of production. Then it extrapolates it to what happens if the level of production increases. Well, remember the canoes, right? I think it was 540, 620, 780, something like that, right? All we did was take what we knew about 540 canoes and extrapolate it to a larger number of canoes, okay? Now, look at exercise 5. Exercise 5 says, refer to the information for Morning Dove in exercise 4, and suppose it sells each bird bath for $25. Calculate the per unit contribution margin and contribution margin ratio for each bird bath sold, and prepare a contribution margin income statement, assuming that Morning Dove produces and sells 1,400 units. So why don't we do that part first? Because then I think we could work backwards. Exercise 5-5, right? And this is also on page 241, and then it goes over to page 242. Right, so if we do this backwards, produce a contribution margin income statement. So the name of this company was Bird Bath, or Morning Dove, I'm sorry. Morning Dove Company. Contribution margin, income statement. Let's just say for the current month, because they didn't give us anything in particular, right? Sales revenue. $1,400 units were produced and sold times $25. They told us that we sold these things for $25 a piece. 1,400 times 25 is $35,000. Am I going too fast for you guys? No? Did everyone fall asleep on me?
No, it's fine.
Okay. So why don't we do this? I started it. Why don't you see what you can do with it, right? We're going to take sales revenue less variable costs, right? And what do we know about the variable costs? They were $19.50 a unit, weren't they? Right? Go back to the last thing we did up here, right? The variable costs were $19.50. The fixed costs were $4,680. Right? And then that'll give you contribution margin, right? Less fixed costs, right? And the fixed costs were 4680, right? And then that will give you net operating income. Right? And this was based on total dollars. This will be per unit, right? And then this column will be percentage. Okay, so based on the numbers that we have, why don't you see what you can do with that? It shouldn't take you any more than 5 minutes or so to finish that. Let's say 10. All right, see what you can do with that. Take a few minutes. Okay. So let's say what maybe you came up with, right? So now the variable costs, we have to take the per unit, which was $19.50, and multiply it by the 1,400 units, right? That's minus 27,300. So the contribution margin then is $7,700. Right, the fixed costs were $4,680. Right, so the net operating income, $3,020. Right, $3,020. Now we can do the same thing kind of on a per unit basis, not with fixed costs though, right? Just with the up to contribution margin, because go back to that Starbucks example, right? If you go back to the textbook and you look at the Starbucks example, that's what they did. So the selling price was $25 for one bird bath. The variable costs were $19.50. So the contribution margin was $5.50. $5.50. Okay, now as a percentage, how do we do this as a percentage? Well, we take the $5.50 and put it over $25. And that'll give us the percent. Right, and that comes out to 22%. Not $22, 22%. The sales revenue is always going to be 100%. 100%. So what would the difference be? 100% minus what? Would that be 78%? Of course, what you could do is you could take the $19.50 and put it over $25 to get that 78%, but you really don't have to, right? Because if you're comfortable that that was 22%, then that has to be 78%. 100% minus 78% is 22%. All right, now let's look ahead. Chapter 6. Chapter 6, cost volume profit analysis. There's another term for that. We call it break-even analysis. Wouldn't it be nice to know if you had a business, how many units you would have to sell of something to break even, or how many dollars of sales would you need to generate to break even? All right, so break even is part of it. See objective 1, break even point. What about a target profit? What if you were to say, well, gee, I don't want to just break even. I want to make $100,000. right? What would I have to do to make $100,000? And a margin of safety is somewhere in between, right? So we'll look at that, and other things flow from that. I don't know to what degree we're going to get into these other topics. I don't think we do number 5 at all. We don't do number 6 at all. See, number 6, multi-product, right? Now, again, when we look at this, we're doing it on one product. So, let's say you had a business and you sold just one product, fine. But what if you made, I don't know, 20 products or 30 products or 100 products? You would have to do the same thing for that. And you have to determine the product mix, because you can have different profit on different items. In other words, you might sell one product where the contribution margin is 22%, like we just saw. You might sell another product where the contribution margin is 40%, right? And then you have to make a lot of different assumption of how many of each product you're going to sell. We're not going to do that, so don't worry. Don't panic. We're just going to deal with one product. Okay. So are there any questions about any of this? Because you got plenty of time to get your chapter 5 homework done. I want to do chapter 6 next week, and this way we can even talk about the exam a little bit also next week. Right? So if there's no other questions, why don't we wrap things up for today, right? And take the extra time you have to get started on your homework. All right, everybody?
Thank you.
Okay.
Thank you.
Have a good weekend. It's a lousy day outside. It's pouring here where I am. Perfect day to do accounting homework. Have a good day and a good weekend. And I'll see you next week.